Ready to pass the CPA exam faster? Visit cpapass.ai. Today, the absolute assurance illusion, why audits never guarantee 100% accuracy. Many CPA candidates fall into a classic examiner trap, believing that an audit guarantees 100% financial accuracy. In reality, absolute assurance is an illusion. Think of an audit like a doctor's checkup. A thorough physical exam can catch major health issues, but no doctor can guarantee you are 100% healthy or will never get sick. Similarly, an auditor's true role is not to act as an infallible guarantor of perfect books. Instead, we act as independent referees, providing an opinion on whether the financial statements are presented fairly in all material respects. We're here to bring credibility and trust to the financial system, not to promise absolute perfection. To succeed on the AUD section, you must master the difference between reasonable and absolute assurance. Reasonable assurance is a high, but not absolute level of confidence that the financial statements are free of material misstatement. Absolute assurance, which means a 100% guarantee of perfect accuracy, is completely unattainable in a practical audit. To lock this concept in your memory, you use the mnemonic RNA: reasonable, not absolute. Just like biological RNA is essential but doesn't represent the entire genetic blueprint on its own, reasonable assurance is highly valuable, but is not a perfect guarantee. When you see any exam choice promising absolute certainty or a guarantee, eliminate it immediately. Why can't auditors provide absolute assurance? Because of three inherent limitations. First, consider the nature of financial reporting. Management must use estimates and professional judgment, meaning accounting numbers are rarely absolute facts. Second, look at the nature of audit procedures. Auditors cannot check every single transaction, they rely on selective testing. Furthermore, sophisticated fraud or collusion can be intentionally hidden from even the most diligent CPA. Finally, we face cost-benefit constraints. Audits must be completed within a reasonable time frame, and cost, preventing infinite testing. These limitations mean audit risk, the risk of being wrong, can be minimized to an acceptably low level, but it can never be reduced to zero. Auditors navigate these limitations using two critical tools: materiality and professional judgment. Materiality refers to whether errors or fraud are big enough to influence the decisions of a reasonable user, like a bank or investor. For example, a $200 error in a $10 million company is immaterial and ignored. However, a $50 million error is highly material and must be corrected. Professional judgment is the trained expertise auditors use to apply these concepts. Instead of blindly following a rigid checklist, auditors must constantly evaluate how much testing is enough and whether the evidence gathered is sufficient. You must understand that materiality is a matter of professional judgment, not a fixed mathematical formula. And let's look at how the examiners will test this. Watch out for absolute trap words like guarantee, ensure, complete accuracy, or detect all errors. If an answer choice suggests the auditor guarantees perfect books, eliminate it immediately. Another common trap confuses responsibility boundaries. Remember, management is always responsible for preparing the financial statements and maintaining internal controls. The auditor is only responsible for expressing an opinion on those statements. If a question suggests the auditor works for management rather than the users or that they prepare the books, it is incorrect. To master these distinctions and practice realistic simulations, head over to cpapass.ai to test your knowledge and build your exam day confidence.